Welcome back to Overtime. Some prominent bank CEOs this week on CNBC warning that cracks are starting to show in the U.S. economy. JP Morgan's Jamie Dimon and Morgan Stanley's Ted Pick yesterday. Wells Fargo CEO Charlie Scharf telling Squawk Box this morning that he, quote, sees more downside to the economy. But joining me now exclusively here at Goldman Sachs Communacopia and Technology Conference in San Francisco is David Solomon, Goldman Sachs Chairman and CEO. And I do want to talk to you about that. But first, I think we have to talk about where we are right now, especially given how voracious the market is about AI on the heels of this monster move in Oracle, and so many, I would call them optimistic takeaways from CEOs here at this conference.
Well, first of all, thank you for being here, and thank you for having me on the show. This is a conference we started in 1991, and if you think about the changes in technology and media over that period of time, email was just invented in the early 90s. Nobody had it. You think about where we are with AI, you think about the interest. There are 3,000 clients here. Hundreds of companies, coming together, and really, of course, the theme is on how this technology is accelerating, how is it going to evolve, how is it going to create productivity, and the level of excitement and the tailwinds that has for economic growth and investment are really, really quite strong. And so it's fascinating to be here. There's a lot going on in the world. We can talk about the macro and some of the things that balance, but if you're looking, over the horizon, these are powerful forces that certainly are going to drive growth and productivity in very interesting ways.
Do you think the exuberance, and I think all the spending that's going into this, especially in the AI infrastructure piece of this right now, does that justify the excitement and the moves you are seeing in some of the stocks and whatnot?
Well, the excitement is justified by the impact this technology can have over time. Whenever you have a new technology, and we've seen this, over many cycles, there tends to be some excessive exuberance about how quickly the change can be implemented in the enterprise, how quickly the productivity gains can come. And my guess is this will be no different. So there are going to be some amazing companies that are formed. There are some amazing companies that have been formed and grow. There'll be lots of companies that are formed that don't make it in the long run. And that's part of the natural cycle. But it's very good for our country to be in the middle of this innovation, as we have been in so many other technological innovations. And, I think you just have to have the lens that whenever there's a new technology, there's going to be some irrational exuberance, and this will probably not be any different.
I want to get your thoughts on the other sort of big market news of the day, and that is we had Klarna's IPO. I know you're one of the book runners, Goldman is. We've got more IPOs before the end of the week, and you've made the comments, even just earlier this week, that deal making is strong. Does that continue?
There's no question the pickup in deal making is really significant. You talk about the Klarna IPO. We were excited to help that terrific company go public. That's gone very, very well. This week, we will do more IPOs and have more IPO activity at Goldman Sachs than we've had since July 2021.
Wow.
So equity issuance this year is up about 15%, but over the last 2 months, it's up 40% year over year. So there continues to be an acceleration. You're certainly seeing pickup in IPO activity. And on deal-making activity, I don't think people really appreciate this, M&A activity is up about 32% year over year. So 32% more volume. But in deals bigger than $10 billion, M&A activity is up 100%. So the deal-making environment has really accelerated. And I think one of the reasons for this acceleration has been the regulatory environment is unleashing CEOs to think big and think strategically and think about how scale can advantage them in a relatively fast-changing world. And we're coming off a period for 5 years where the regulatory environment was inhibiting that. And so I think we're going to go through a pretty good run here over the course of the next 12 to 24 months with meaningfully more M&A activity and more IPO activity.
It's interesting to hear you say that because we keep hearing about uncertainty in corporate America. That doesn't sound like uncertainty.
Well, you've got conflicting things, going on for sure. There's a lot of optimism around technology innovation. And there's certainly a strong belief on the part of CEOs that scale matters, and they feel like they have an opportunity to position their businesses for the next decade. And you don't know how the regulatory pendulum can swing, obviously. We have a system where we definitely have swings back and forth, and so this is an opportunity for CEOs to be a little bit more aggressive strategically. Countering that or balancing that, and you mentioned at the beginning of the segment that there are a number of CEOs that are talking about a softening in the economy. There's no question we've seen some job data that indicates that there has been some softening. I think you have to watch that very, very closely as we look ahead. The economy is still chugging along, okay. But there's no question that we're seeing more softening signals. So I think that's something to watch very carefully.
What did you think of PPI this morning?
I think that, when I think about inflation and I think about where we are, there's still more work to do. And so, I think it's uncertain. I've said it a number of times. I think there's going to be a stickiness around how this all settles out. And I think we're continuing to see indications that that's something to watch very closely.
How do tariffs factor into that? How are you thinking about that?
So trade policy is still getting negotiated. It's still getting implemented. The administration has a clear point of view, but there's uncertainty around where this all lands. And there's no question in my mind that it's having an impact on growth. That impact on growth is hard to quantify specifically, and I think it's also very dependent on where a lot of this lands. There's obviously litigation now going on around some of the reciprocal tariffs. We have to watch that closely. There's still trade deals that have to be negotiated, particularly here in North America. So I'd say there's still uncertainty. There is an impact to growth, and we have to see where this all lands.
I do have to get your response to President Trump's criticism of the bank's research a couple of weeks ago. He went as far as saying in his social media post, quote, "I think that David should go out and get himself a new economist, or maybe he ought to just focus on being a DJ."
Well, I like DJing. I mean, that's a lot of fun. But Jan Hatzius is an incredible economist. He has been cited numerous times for his work. And our research serves our clients. Our job from a research perspective is to provide research and analysis that helps our clients make the best decisions possible. Jan has an extraordinary reputation, an extraordinary track record, and we're proud that he's a member of our team.
Have you spoken to President Trump since all that happened?
I speak to the White House, regularly, and I'll continue to speak to the White House and engage the White House.
Market seems to be pricing in as a foregone conclusion, given the conversation we're having here, that we get a cut next week. Do you think it could potentially be a jumbo cut, or this sets us up for a flurry of cuts?
There's no question that when you look at the labor numbers, there's a little bit of softening, and I'm pretty confident that we'll have a 25 basis point cut. Whether or not we have a 50 basis point cut, I don't think that's probably in the cards. So I would expect a 25 basis point cut, and I think you could see one or two other cuts, depending on how economic conditions play out from here. But there's no question we're going to see a slight change, in the policy rate as we move into the fall. And I think it'll be really data dependent on how things evolve as we go through the rest of the fall as to how that plays out.
Do you think there's a real risk that Fed independence is in question here, or at least that the optics of Fed independence are in question here?
Well, there's a lot of noise and a lot of discussion around this, but I'd make a couple of comments, on this topic. First of all, I think that central bank independence, not just here but around the world, has served us well, and I think it's very, very important. I think Fed independence is very, very important around monetary policy. I think the people who are in the Fed and make these decisions, and by the way, it's not an individual, it's a committee of people that vote, I think they take it incredibly seriously. And I think as you look forward and you look at appointments, and by the way, we saw Stephen Murrin at his hearing talk about the fact that he thought Fed independence on monetary policy was very, very important. So presidents and administrations throughout history have had a point of view about policy rates, and they voice them. The people that go and act on monetary policy, I think, do it to a very high standard, and I'm confident that they're going to continue to do it. But I think it's important for all of us to appreciate how well central bank independence has served us.
I do want to get your thoughts, and you and I have talked about this in the past, the debt load of the U.S., spending deficits. You were on stage with Bill McDermott from ServiceNow earlier today. One of the things he said to me here on CNBC before he got on stage with you is that the amount of adoption in government for efficiency, productivity gains through digitization, technification, if you will, that is a dynamic that is changing government. And I wonder what that means for the future of spending by government and whether it factors into this deficit conversation, especially at a time where the bond market's really focused.
I would say it's interesting. I had Bill McDermott on stage and I interviewed him, and I asked him the same question. And I'm encouraged by his answer, but I'd say, at one level, his answer is encouraging. On another level, there's a lot of work to do. I don't think that we've shown that we have an ability to decrease the growth in our fiscal spending to zero. It's a question of how much we're going to grow. And the reality of it is we've grown our debt stack very meaningfully, and we've got to think about a growth play that can allow us to have enough growth in the economy to make up for the debt burden, the financing burden we have. I think this is a super important issue. It's something I've talked about regularly for the last few years. I'm concerned about the pace of fiscal stimulus and our inability, to pull it back, especially after the way we accelerated it during the pandemic. And I'm not saying that this is an emergency in the context of this year or next year, but this is ultimately something that will affect growth and will affect the power of our economy. Because if you think about the growing debt stack and what it costs to finance this debt stack, over time that diverts capital from other productive uses in the economy if we have to raise more and more financing to support, our government. So this is a real issue, something to watch carefully. I'm concerned about it. By the way, it's going on in all developed economies around the world. We have great advantage because of the dollar. You can see what happens if you're not in that privileged position. For example, if you look at the UK and you look at what's going on in gilts over the course of the last couple of weeks. And so this is something we should be sensitive to, but I don't have a good answer how to slow it down, because from both sides of the aisle, there's a desire to keep running this very aggressive fiscal play, and it's something that should raise concern for all of us, because we are going to have to deal with it at some point in time.
Okay, we're coming up against the end of the show, so we're going to have to leave the conversation there. There's always so much to talk to you about.
That's not an optimistic enough note. I mean, can't we end on something a little bit more optimistic?
Stocks at all-time highs. What do you think? Makes sense where we are in the investment cycle?
I think there's no question that what's going on with technology and the concentration in the market is having an impact on where stocks are. If you go back to what we said, this technology is super important, it's accelerating. I think there's a little bit of exuberance, around risk taking, but at the same point, it can go on for quite a while, as we've seen in many other cycles. So, I'm excited about what's going on, but also cautious. And from a risk perspective, we always have our risk hat on, trying to be as balanced and appropriate as we can.
Okay, David Solomon, CEO of Goldman Sachs. Thank you.
Thank you. I appreciate it. Thanks, Morgan.
John, I'll toss it back over to you.
Great stuff from there, Morgan. Thank you. That's going to do it for us here at Overtime. Fast Money starts now.